The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and I'm in Buffalo, and I made it out from Marco Island. And all of you guys that called me, I must have had hundreds of people that emailed and texted because they saw that I was on Channel 2 the other day. Adam Benini told somebody, I think Esther Gulius is down in Marco Island for this week. So somebody called and said, are you really in Marco Island getting ready for the hurricane? And I said, yes, unfortunately. I'd love to get out of here, but there's no room in the inn. And the only flight I had was the one I had booked originally on Thursday. And I got out on that one, and I am so thankful. I'll tell you, we may have blizzards here, but you ain't lived until you see everybody boarding up their house. It's like, oh. But anyway, everybody that called me, I am back in Buffalo, thank God. And I have no idea what's going to happen to my house in Marco, but I'm here. And I got Tiffany Fabian here.
Hey there, Esther. Were the airports crazy when you were on your way?
It was, and Chris Fabian.
Hello, Esther.
I flew out of Fort Lauderdale.
Right.
And it was wonderful. I mean, I flew Southwest direct. There was a direct flight from Fort Lauderdale to Buffalo. Everything was full, though. I mean, there were people hanging on the wings to get out of there. It was, but I think the weirdest thing was I had filled up my tank in gas, and I thought, well, in case they cancel the flight, because my other girlfriend, who's also in Marco, she and her husband were supposed to take an Allegiant flight out on Thursday,
right,
and they canceled the flight. So they drove up to South Carolina, and it took them a 9-hour trip. Took them 24 hours. So, and every place they stopped, my other girlfriend said that it was not fit for man nor beast. Any place that had room in the inn was not fit for man nor beast. And then my brother finally left Naples, and he was going north with his daughter and her husband. And they had to go 30 miles off the 75 to get gas. So then he said the rest stops. I know we're supposed to be talking about taxes, you guys. But anyway, but I said, what a casualty loss I'm going to have on my tax return this year. But anyway, he said that the rest stops, they thought they'd sleep for the night. He said there was like 3,000 to 4,000 people at a rest stop with people building tents and everything. Anyway,
didn't he
give me a blizzard anytime?
Didn't he say this is something on his bucket list that he wanted?
Oh yeah, he said this now is in his bucket list that he's been evacuated with 5 million people.
Oh my God.
Oh, anyway, but we do pray. I have to tell you, I pray for everybody that was. I called the Marco Island police today, and I said, like, how many people are left on Marco Island? Thinking 20.
Right.
She said 8,000 to 9,000 people stayed.
Oh my gosh.
And they're looking at a storm surge of 15 feet, 12 to 15 feet. That means everybody's house is underwater.
Yep.
You know. So, anyway, we do pray for everybody that stayed. My other brother's in Naples, in Bonita Springs, and he is sick and he can't leave.
Yeah.
You know.
Yeah.
And so it's just unbelievable.
But
anyway.
I think the medical facilities, like down to skeletal
crews. Well, they told them they're not doing any medicine right now. I wonder why. Anyway, we're going to talk about taxes,
school.
And we want to talk about retirement today, Social Security, and tax school. Chris, school starts pretty soon, right?
School starts in the middle of October, October 13th. We have classes at 4 locations this year, not including our online course. We have West Seneca, we have Amherst, Lockport, and Niagara Falls.
Right now, and I'll tell you, it's a phenomenal tax course, and it's tax deductible, right? Because you're learning all about your
finances.
But we do take entry level people as beginning employees. We have a 4-year program for education, and it's absolutely a great class. And so if you want to register, you can call us at our office, right?
Okay, the phone number here.
632-7886.
Or you can go online to egtax.com and you can register.
That's how you started in taxes many years ago, and that's how Chris and I started.
That's exactly true.
You know, and even maybe if you've done this for yourself for a while, you've done it, you know, a little here or there for someone to help out. If you want to try it, you know, make a 3-month career. I hate to say 3-month career, but 3 months out of the year you work. Where else could you say that? You know? I mean,
it's a wonderful job. It's a wonderful thing to do is help people. Why don't we go to the phones before we talk to your other calls? 8030930, 8030930, star 930 on a cell phone. We got Carol from Lancaster who's been waiting. Hey, Carol, how can we help you, my dear?
Hi, I have a rental house, and I have to put a roof on it and do some gutters and stuff, and the tune of like $15,000. I was wondering. I know I've heard before that you can claim it as a partial or full this year. They changed the law or something, and I don't remember what you had said about that.
All right, Chris, you want to give us the lowdown?
That's here? For any assets you do to your rental property that have a useful life of 15 years or less. Unfortunately,
so that would be like your
refrigerator,
right?
Yep.
So you're going to depreciate that at 27 and a half years.
Right.
So that's going to be a little bit. Are they going to still have for 2017 that exclusion for rentals?
That's what we were just.
That's what we're talking about.
Yeah, no.
So, Carol, what you're talking about, there's an accelerated depreciation allowed. If the thing that you're the thing that you bought, the capital thing that you bought was machinery or equipment or that has a useful life of less than 15 years. However, a roof has a useful life of 27 and a half years. So you have to depreciate it 1/27 and a half.
So about $545 a year.
A year, right? Over 27 years.
Listen.
But it's better than nothing, right?
Yep, I guess I partially listened when you said it, and I wasn't sure how it worked, but I figured calling is the best way because then you. That's for sure. That is for sure. But better than nothing, and you know. So it's a depreciable asset over 27 and a half years.
And then don't forget, for a landlord, you could deduct mileage, and so you want to keep really good track of all your records as a landlord.
Right, picking up rents. Going to the Home Depot, Lowe's, anything, that's all deductible as well. So, but unfortunately, the roof, 27 and a half.
Compliment you guys. I've had my taxes done at you guys, and you've done a great job.
Well, thank you so much. Aren't you glad that we get blizzards and not hurricanes, Carol?
And I want to welcome you home. I was hearing your blow-by-blow coming home, and I'm going, oh, my God, I hope she gets home fine.
Well, thank you so much. Thanks, Carol.
All right.
Bye-bye. I'm Esther Gulias, the tax lady from EG Tax, here in the land of ice and snow, but we don't have any hurricanes. Yay for us. We're going to take your phone calls after the break, 8030930, 8030930, star 930 on your cell phone. We'll see you right on the other side. I'll tell you, when you don't die, it makes you very happy. I'm not dead.
I was going to say, usually it's what we want is what Florida has, but I think it's vice versa right now.
Oh, I'll tell you, 4 hurricanes at one time. Anyway, I'm Esther Gulias, the tax lady, 8030930, 8030930, star 930 on the cell phone. And Dave's been waiting so long. Hey, Mr. Dave, how can we help you, sir?
Well, you could help me out by getting rid of that hurricane. I've got a home down in Daytona. I get out in the wintertime, and we'll probably be losing it.
Yeah.
And I'm 69 at the end of the year here.
Okay.
Got a 401k.
Okay.
And I understand at 70 and a half, I got to start doing something with it.
Yep.
Could I take a cash buyout on that? In other words, go and cash it in after the hurricane.
All right. Well, let's do a little tax planning here, Dave. Is your house? How much is your house worth this minute before it gets blown down? What would you think?
80.
With everything in it, all your furniture and everything.
Close to 100.
All right. So we got 100. And do you have insurance on it?
I have insurance for everything except wind and water damage.
Right. So. So you have no insurance on it, really, except FEMA, whatever. Well, let's just say that you end up with $20,000 in money. All right.
Okay.
So that would mean you'd have an $80,000 casualty loss, and you'd have to reduce that by 10% of your adjusted gross income. And so, do you have a pension plan, Social Security?
He said a pension.
I've got Social Security, and I'm a 100% disabled vet.
All right, so that the VA pension's tax free. So
you don't have
we'd
to
end up
file,
with
right?
you have about an $80,000 potential casualty loss. So he could take, let's say, $60,000 out of his pension plan and cover it, but with his casualty loss. But
And that
don't
would-
do it, Dave. I mean, I'm just saying you could, because if you have the one, God forbid, you'd be able to take the money out and cover it with the loss on the other end. So on the left hand would do the right hand. But before you do it, we want to make sure that you don't do it based upon what some lady says on the radio. We want to make sure that
all
it's
the
correct.
numbers.
I want to look at all the numbers, but that's the way it would work.
I see.
So it is absolutely something doable. But let's hope that your house doesn't get blown down and you do get more insurance than $20,000.
Are
But
you
could.
married or single, Dave?
No, I'm single.
Okay.
Yeah. So how much is in your pension plan, Dave?
Not much.
How much?
About 44,000.
Okay, but it looks to me like that would be a great plan for you.
Yeah, I'm thinking about if I take.
Because for sure he'd end up with taxable
Whatever.
Social Security.
Yeah.
The Social Security would be taxable. So it looks like the casualty loss would be more than that.
And-
But and any of the excess you could carry back because you'd end up with a net operating loss.
And I'm thinking he should take out, if he was going to do it, some in 1 year, split it out
Why?
over the years.
Why? If he's got all that
He's
money?
got the NOL.
Right, right. If he's got an NOL.
Right.
Yep.
Yeah, I mean,
Or the
it sounds to me
casualty.
like you'd be able to get rid of the whole thing, but call us first. There's no charge. We'll sit down and plan with you. And I know you're in Jamestown, but we can still do this long distance, okay?
That'll work.
All right, Dave. Good luck.
luck.
Good luck to both of us, right? Thanks for calling. I'm Esther Gullius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. And really what you just heard us do is tax plan, right? Because you can create, if something happens to you, you can create a deduction or an offset by knowing some of the tax laws. So that was a really smart thing that Dave said.
That's right.
Absolutely.
Yep.
President Trump, when you looked at his taxes, he had an NOL, and that's what.
That's right, because he lost his shirt someplace.
That's right, and Dave would have an NOL as well.
Right. And
Possibly.
anybody that's got property down in Florida, if you do not have insurance that covers or any benefit from FEMA or whatever that covers the loss that you're sustaining, you will have a deductible casualty loss for all intents and purposes. And so you want to make sure that you plan.
They would allow you to not have wind and water insurance.
You don't have to. I mean, if you have no mortgage, nobody
Right,
makes
right,
you do
right,
anything,
right.
right?
Yeah.
The truth of the matter is, flood insurance is really inexpensive. My flood insurance was like $545.
Not if this occurs.
But my wind and my wind and water damage was $9,000. So, so that's a serious thing. But believe me, my insurance company in Florida already texted me and said, gee, we see you live on Marco Island. You're probably going to have a claim. So when your insurance company's writing you, that's not a fun thing. Okay, let's talk about pension planning, right? And that's, that goes right up the tax planning kind of thing. Why is it important that people put money in a pension plan? Not just because they're going to get old.
Well, it's so funny. I was thinking about this. My father, he worked at Ford, and he had a pension that Ford did for him. Chris and I, we have to, and we're sort of in a land nowadays where you don't have that beautiful thing. You have to build and grow your own. So I have
But
to.
I think your employer does a match.
Yeah, but the
doesn't
one,
she?
yeah, but the one at Ford, they.
Oh, I know.
Yeah.
You mean the you didn't have to contribute to
yeah,
it.
you didn't have to
but it's
contribute.
very important to save for your future. But
Yep.
the other thing is, what's the benefit when you put money into a 401k
you
or
tax
403,
save now.
Right. And part of what they're thinking about doing under the proposed tax law changes is to make it all like a Roth. So you would lose the benefit now, and you would basically pay the taxes up front, and then somewhere down the line it would be tax-free when you take it out.
She's pointing at Marco Island.
Yeah, that's on the weather report. Yeah, right. So let's say that you are somebody that's interested in making some contribution to your pension plan. How much can you put away, and is it a percentage of your wages?
It is not a percentage.
It's called an elective deferral.
Yeah. What are we up at? 16,500.
18,000.
18 for if you're over the age of 50.
50. No, if you're up to the age of 50, it's 18,000. If you're 50 or older, you can put 24,000, and that is just a number that you can put in yourself. So if you were in the 25% bracket and you put in $24,000, you save $6,000 in federal taxes and like $2,000 in New York State. So you save $8,000 in taxes up front.
That's huge.
So you're not only getting the benefit now, but you're building a nest egg to boot, right?
And they're talking about taking away that beautiful thing, which is not
that is
very
true.
cool.
That's exactly right. Why don't we go to the phones and we're going to talk to Leslie. Hey, Leslie, how can we help you, my dear?
Yes, I have a question.
Sure.
Husband passed away in August.
Okay.
I know I will file married filing jointly this year.
That's right.
Could you tell me what would the filing status be for next year?
You guys want to tell
married filing? I mean, you're going to be single unless you have children. Then you'd be qualifying widower. So you're going to be single.
Is there anyone that lives with you, Leslie, besides yourself?
Pardon?
Does do your children or anyone that's dependent upon you live with you?
No, I live alone.
All right. So next year you will, if you remarry, then you would be married filing joint with your new spouse. But if you stay single, then in 2018 you'll be a single taxpayer.
I would be, because years back, wasn't it that you could be for like 2 years?
No, you would have had. That's why Tiffany asked if you had children. If you had a dependent child, then you'd be qualifying widower for up to 2 years after the death of your spouse if children were dependent upon you. But in your situation, with no children, you revert, boom, right after that year of death, back to single.
So that's one of those life changes that you really want to plan on.
Right, because your Social Security will become taxable at a quicker rate once you're single.
And so when this occurs, give us a buzz so we can plan
with you.
Yeah.
All righty.
All right, dear. I'm sorry about your husband.
Appreciate it.
Thank you, dear. All right, let's go to the phones and talk to Darlene. Hi, Darlene.
Yes, hi, Esther.
What can we do for you?
I'm wondering if I'm going to be 70 and a half this coming year, and I have to take an RMD. Can I take half of it in 1 year and half of it in another year, just so that the taxes aren't all?
All right. So tell her about what happens in the year you turn 70 and a half.
You have to. It's a required minimum distribution for that year, because then the following year you have a different minimum distribution. So you have to take it all this year. If you don't, you will get hit with a 50% penalty of what you don't take out.
However, she does in the first year.
Years because she has the April 1st.
You can make an election to not take it out this year at all, and next year by April the 1st you can take your first RMD for the previous year that you were supposed to be 70 and a half, and a second RMD before December 31st. So in this year, in the year that you turn 70 and a half, you have to take it out, like Chris says, unless you make the election to double dip the year after. And then the first distribution would have to be before April the 1st, and the second distribution that year would have to be before December 31st.
And that's, again, tax planning. The reason that somebody might want to do that is maybe your income is higher for the year that you turn 70 and a half, and when you are down the years, maybe your income goes down. So it all plays into tax planning.
Okay, one more thing.
Yeah.
If I have multiple IRAs, do I have to add them all together and take a total? RMD, or can I take it out of a smaller one?
You can take the collective amount out of one IRA. Usually the one that's performing less well is what you're going to want to take the collective out of. If it's a 401k or pension, you can't do a collective on that. But IRAs, you can group them together.
Okay.
Okay?
Thank you so much.
Thanks, Darlene.
Bye-bye.
Bye-bye. I'm Esther Golias, the tax lady.
Darlene. Yeah, it was
Darlene, right?
Darlene.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We got Mike from Lackawanna. Hey, Mike.
How you doing, Esther?
I'm good. I'm in the land of ice and snow, and I love it
I
here.
love that name, Lackawanna.
What
Good
can I do
Indian
for you,
name.
sir?
A place down in Florida.
What's that?
Things turn. I said, don't you have a place in Florida?
I may not after tomorrow.
I hope things turn out good for you.
Oh, well, thanks, Mike.
All right, I have a question concerning my son. I think you were talking about IRAs.
Yeah.
He actually is paying back school loans, and every time he gets a small raise, they increase the amount of his school loans, and he doesn't even have an IRA yet, and he's in his late 30s. Now, I'm just wondering if you know anything about that, or whether it would be better to call you during the week.
So that's income-based.
Right. What he has is an income-based repayment of his student loan. And you have an opportunity to refinance those student loans. And, you know, Tiffany is like an expert at student loans. What I'd suggest you do, Mike, is have your son, there's no charge, call Tiff, and she'll talk about some of the options for refinancing. But when he's got an income-based student loan, when his income goes up, they're going to charge him more. What does your son do professionally?
He's not really working in his degree, so I don't really want to say.
Okay. All right. Well, the thing is, had he been working for a not-for-profit, and maybe he's working for a municipality doing something completely different than his degree is, but he's working for a municipality or for any non-for-profit. If he's timely paying his student loans, after 10 years, it would qualify for forgiveness of the student debt. So that's something else that he'd want to look into, okay?
Do you know if they're government loans or if they're private loans?
Any money that comes to an IRA is taken out before taxes. When you go income-based, if he took money out, don't they go on adjusted gross income, and would that show up in there, added back later, or not?
I believe it with income-based. We'd have to call to make sure. I'd have to call.
Yeah, the thing is, Mike, I'm at the bottom of the hour here with the news, but why don't you call us at 632-7886, and Tiffany will work with your son, and there's no charge. Okay?
Thank you.
Thank you, sir. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break for the news. We'll see you on the other side.
There you go, Frank.
All right, Frank's got a hurricane song for us. I'm Esther Golias, the tax lady, and I'm out of Florida, thank God. And I may not have a house next week, but anyway, I'm so thankful to be back in Buffalo. And for everybody that contacted me, texted me, called me, and everything else on Facebook and everything, thank you for your kind wishes. It really is scary if you're down in Florida, I'll tell you. So on income base, we wanted to get back to Mike. I think it was Mike that was calling. It is based upon AGI. So if the son put money into an IRA, that would help his income repayment, albeit it's only a percentage.
And then also help because he's putting money away for his retirement, too.
Correct. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930, and we're going to go to Greg, who's been waiting for so long. Hi, Greg.
Yes, hi, Esther.
What can we do for you, sir?
My question has to do, I assume that New York State has a death tax, and I'm...
Are you kidding? You know that they do.
Anyway, what are the assets that count, and what are the limits, please?
Well, Chris, you just did a research on the estate taxes. The estate taxes parallel the federal until you get to the federal level, and then something happens.
Oh, yeah. New York State will say there's a $5 million exclusion. But once you hit, it's like 115% of that, even smaller. They tax you on all of it.
All of your estate.
So and that means your house, your jewelry, your cars, your pension, your life insurance. Everything and anything you have go into your estate.
That you would have owned at the date of your death would go into there.
But roughly it's around $5 million.
Right, but let's say that it's $7 million. Your estate is, then the $5 million goes away, and now you're taxed on the $7 million
for New York State, and $2 million for the federal.
Right, and $2 million for the federal.
Oh, okay.
Okay.
Great job answering the question. Thank you.
All right, thanks, Greg. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930. Call us if you have a tax question, you got a hurricane thing. Love to hear what you have to say. Okay, let's talk back about the benefits of pensions. Let's say somebody has a need, has a 401k, 403b, and they have a hardship. You can borrow against your own pension plan, right?
Yeah.
And how is that treated?
That it's not taxable as long as you make the payments that you're supposed to, and you're making the payments back to yourself, so the interest is being paid back to you, which is really
so
really
you can
nice.
Borrow against it. What if you default on the loan?
Then that by the end of that year, you're going to get a 1099-R, and you have to pay on that money that you've defaulted on.
Right,
and
plus the penalty.
That's right.
Right, but these are things that people need to know. And we talked about double dipping. Why don't we explain that again? In the year that you turn 70 and a half, you have to start taking money out of your pension plan, maybe unless you're doing what?
You're still working for that company.
That's right. So if you're still working for the company past 70 and a half, you don't have to do an RMD on that pension.
That's right.
But if you are really retired, then in the year that you turn 70 and a half, you have to start doing your required minimum distribution. Now, a lot of times people think that means that they got to take it all out. Is that correct?
No.
How is it withdrawn?
There's a life expectancy. In the first year, it's 27.4, which is a divisory rate. It's not a percentage. It's a divisory rate. So you would take what you have in there and divide it by 27.4, and that would give you your minimum distribution.
And so if you had $274,000 in your IRA, you would take out $10,000, right?
Right. Yep.
That's so, right. And then next year, see, because they're saying, oh, if you made it to 70 and a half, then we say you're going to live to be 97.4, right?
That's right.
Pretty much. And then next year, that divisor gets a little smaller, and they make you take out a little more,
that's
right?
Exactly
and
right.
that's how the required minimum distributions work.
And that example that you said, $10,000, don't forget then more of your Social Security is going to be taxable.
Maybe.
Generally. So you want to plan for these type of things.
Right. And so you can, so that would be, but in the year that you turn 70 and a half, we were talking about the double dipping. How does that all work? Do it one more time.
Sure. When you have the option, if you elect, to wait to the year after you turn 70 and a half to take your first distribution by April 1st of the following year. So that would be if you take it out on March 15th, that would be your distribution for the previous year. And then by year end, you would have to take out a second distribution for the current year.
So using the $274,000, again, just easy math, the first distribution would be $10,000, and the second distribution would be maybe $10,500. Mm-hmm. So you'd have $20,500 in 1 year, and that would be the year after you turn 70 and a half, right?
Right.
So this way, if you have a large deduction that year, you won't, even if you didn't, let's say it's $20,700 that was extra in income, right? If your Social Security, let's say your Social Security is $10,000, so not much of the Social Security is going to be taxable. After your standard deduction and personal exemption, you're really not going to pay much. You're going to be in the 10% bracket anyway. So you're probably only going to pay $1,000 in taxes on that money anyway if you did the double dip.
That's right.
Right?
And how about the people who maybe only be living on Social Security who are now 70 and a half and, I'm only going to take out my $3,000 minimum distribution.
Oh, that's a great point, Chris.
They could actually, if they're single, like you were saying, could take out about $11,000 a year and pay no tax.
That's right. And so you might say, well, why would I want to take out more? Because then you're taking the money out. Many people are trying to do Roths because they don't want to be taxed on their pension money. There are people that are listening here that don't have to pay taxes, that have money in a pension plan, and it because there's so much difference between your standard deduction and personal exemption and your taxable income, you can maybe take out an extra $11,000 or $12,000 or $13,000 a year, like a Roth, tax free on the federal and the state.
Right.
Yep.
And again, these are things you do when you're tax planning.
Yep. And New York State is kind to retirees. The first $20,000 is tax-free on state, and if it's from government in New York or municipality, it's all tax-free on New York State, and your Social Security is tax-free on New York State.
All right, so let's talk about something cheery. So in the year of your death, right, and your IRAs, pensions are going to go to your beneficiaries. If you have named beneficiaries on your pension or your IRA, then what happens when they inherit it?
They have a few options. They can amortize it over their life expectancy. They can take it out over 5 years, or they can take it all right away up front. So those are the 3 years that they have at their disposal.
And that's only if they're a beneficiary, right?
If they're the non-spouse beneficiary.
Right. So if they're a spouse beneficiary, how does that work?
They can just turn it into theirs.
So the spouse basically rolls it over into their name, and they just do the regular rules for RMDs and things
And
like
if
that.
it's not in anybody's name, it goes to probate, which is really not good.
But then they lose that 5-year and amortization thing, and they have to take the whole thing at once. So if you're on your way to church right now and you haven't got a beneficiary named on your IRA, 401k, annuity, you want to make sure that you add if you like somebody.
Update
right?
it.
Yeah.
Update
you
it.
need to add your beneficiary if you like the person that's going to be getting your pension money, right?
Yep.
Yeah.
So that gives them some options.
Yeah, because it would be really difficult for it to go to New York State, and then you have to deal with probate, and that's always much more difficult.
Right, and somebody that has to take the whole $75,000, $100,000, $200,000, it can be a gigantic tax burden.
It would cause a calamity.
Yeah.
The word from last week.
Calamity. That's right, Calamity Jane. Okay, so now another thing that people can do is if they have IRAs, they can, and they're charitable people. They can give up to $100,000 in a direct rollover from their IRA to the charity.
That's right.
Correct.
And that would that satisfies their RMD requirement.
Yep.
Right. And it doesn't make your Social Security more taxable.
Right.
It does not.
And
Of
it
course,
lowers your estate value.
That's right. And of course, you cannot write it off as a charity, but it does, as you both have said, the other items. You can't use it as a charity.
Right, because you're already not paying taxes on it, right?
That's right.
Okay, now, and the other thing is, how often can you roll over your IRA? So you can, if you have an IRA and you want to move it to another IRA because it's paying a better rate, how often can you roll that over?
A direct that has no limit. An indirect you can do once or twice a year. Once a year? One indirect
All right, so
rollover
explain
a year.
what a direct rollover and an indirect is.
A direct is where Smith Barney rolls it directly over to Wells Fargo, and they take care of all the paperwork and all the nuances.
And you never touch the money.
And you never touch the money. An indirect, once a year, is all they allow of an indirect. You are touching the money, and within 60 days, you're rolling it over to Wells Fargo. And as Esther rightfully says, you're touching the money.
Right, and you have 60 days that you can have control of that money, but within 60 days you have to relinquish control and put it into another IRA,
Qualified
right?
plan.
Qualified plan. And the reason this is the case is there was an attorney, I think, in New York City who was like laddering them. And so he would have one that matured in January, one that matured in February, and one that matured. And so what he would do is every month he would have all this IRA money that came over. He would use it for 60 days and roll it back. And so the court said, wait a minute, this is like not good. So they changed it so you can only do one indirect rollover once a year.
There's always somebody who ruins
That's
it for
right.
everybody
People,
else.
They ruin it for everybody. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break and be back with your calls on the other side. Them doves would be really fleeing around today, I think, in the hurricane. I'm Esther Gullius, the tax lady. 8030930, 8030930, star 930 on your cell phone. Don't forget, our tax school starts middle of October,
13th.
right?
Yep.
Yes.
Right. All right. I want to talk about, we're talking about pension plans, and I know we got phone calls coming in. 8030930, 8030930, star 930 on your cell phone. What's a simple plan, Chris?
A simple is a simple plan. It's a type of a pension plan for small employers that you can contribute. What's the limit? We don't have it there. I don't know off the top of my head. But through your pay, you can do elective deferrals through your pay. So
Right. But the thing is, it's not as much as a 401k and 403b.
14.5.
But yeah, and you as a small employer can set it up. And it is very simple to administrate. There's like no administration costs or very little administration costs. And it's great because you can put yourself in and maybe you only have one or two key employees. And, it's a great thing. Now, a solo 401k is remarkable. Let's say that you're a realtor and you're making $100,000 a year and you wanna set up let's say an SEP, and you would have done an SEP of maybe $20,000. Well, on a solo 401k, you're the only employee, and you can do 100% of compensation up to $18,000 or $24,000 if you're over age 50, and the employer, who is yourself, can do a match of 25%. So you can do, let's say, 18,000 plus another 25,000. So that's like 43,000 that you can put into your 401k plan, solo 401k, and that's remarkable.
Just come and manage you do a great job. We just got to have your mind to manage.
Well, I mean, the whole thing is you have to think about these things. If you don't think about them, you'll never do them.
That's right.
And of course, the last thing is a simplified employee pension, right?
Right. And, and the thing is, you got to look to see what's best for your company, what's best for you. I know I had someone earlier in the week call and say, right now, my company that I'm part shareholder in has an SEP and they want to switch to a 401k. And he goes, why would they do that? And I said, I honestly couldn't tell you, because an SEP, you're able to put in more money than a 401k, but you also could be limited on a 401k to your own contributions based upon all the employees' contributions if you're a highly compensated employee. So you really got to look at the fine details of each account.
And sometimes the owner of the company has sold a bill of goods by some salesperson, right?
Yep.
So it's really important to get that second opinion, because sometimes you think you're really doing something good because everybody's got 401ks. Well, they are expensive to administrate, and you want to make sure that you aren't being limited, because there's all of these. When you have a qualified plan, there's all these laws attached to the qualified plans.
I mean, I remember we looked into going into a 401k, and the gentleman came in and it looked really good, and he goes, well, it's going to cost you $2,500 a year to do each person's tax return for the $5,500. And we said, wait, we do taxes for a living. Can't we do it ourselves? Right. Nope.
Yep. And so it would have cost us like $30,000 or $40,000 in just administration fees. So we didn't do it, right? All right, let's go back to the phones. We're going to talk to Irene. Hi, Irene. How can we help you?
Hello, Esther. I was married for 15 years, and I ended up getting divorced. I had to wait 17 years to get my portion of a lump sum of a pension from Verizon. I got the money, and I bought a house in foreclosure. I fixed it up, and I've rented it out.
Okay.
So is the income I'm earning off the house part of what my pension earned, or is it something I have to report on my personal income tax return?
So different, based upon the way you make your money is the way you're taxed. All right, so on a pension, when you get a pension, since you're getting a pension, if you're getting a pension, that income from a pension is taxed as ordinary income, just like wages, okay? But rental property is a different way to make income.
Taxes on it so far.
I know, okay. But rental property is a different way of making money. And so you're going to do a Schedule E for the rental income. So the rental income is going to go at the top, and all the expenses that you paid to make the income reduce the amount of rent you got. So the property taxes, the insurance, the travel to go over there to take care of the place, the utilities, the water bill, repairs, cutting the grass, snow removal, the cost of the house written off over 27 and a half years minus the land value. All of that's going to reduce the amount of rent you got. And so what's left is all that you're going to pay taxes on. That's on a Schedule E.
Schedule E. Okay, thank you so much.
All right, thanks, Irene.
I wonder if she lives in half the house, too?
Yeah, and
so
if Irene had lived in half the house, then it would be half rental, half personal. But again, the same thing would be the Schedule E would be for the rental portion.
You know, I don't think she would have, but there are a lot of people out there that try to put rental properties in a self-directed IRA, and that's even more confusing when you have that, because you have to make sure you have a trust set up that you don't run, a third party runs, even though it's a self-directed IRA.
You're not allowed to touch the money.
Yep. All the money that comes in for the rent has to go into the trust account. That trust has to pay for all the expenses. You're not allowed to touch it.
Sounds like a real estate exchange. You have to have a mediator or somebody who helps you to navigate it, right?
All right. And the other thing I want to talk about was annuities. Now, an annuity is when you basically say to an insurance company, for instance, here's $100,000. They say, great, we're going to give you 3% a year. Let's say that they're saying that. And so that 3% is growing inside of the annuity. And as long as you don't take the money out of the annuity, it continues to grow tax deferred, right? Which means that when you take it out, the income it makes
the growth,
is going to be taxable, because on the $100,000 that was after tax money. So if after 10 years there was let's see, 3,000 around $35,000 in income, and you took it all out, only the $35,000 is taxable, not the original amount of money. So when people inherit an annuity, they have to go back and find out how much the original basis was for the person who set up the annuity, so they don't pay taxes on it if they inherit it.
Yeah.
Right?
That's right. It makes me think of yesterday, Chris called Mike, right, to ask about insurance companies going belly up, didn't you? Was that? Or
no, that's me, because I was talking to Mike about, it's all great to know that my house is insured, but maybe the insurance company is going to go belly up. And he did research and found out that the insurance companies kind of hedge their bets and whatever.
And so I guess my point of bringing this up is usually insurance companies are pretty good.
They're pretty smart cookies, right?
And they're
pretty smart cookies.
That's why.
Okay. Now the other thing I want to talk about before we're done. And again, anything you hear, we do not charge you. And those of you that have come in to see us, Auntie Esther and the gang, we don't charge to talk to you. So you can call us, come and sit in front of us, bring your paperwork. We didn't have to do your tax return. We will help you, because we just think that if people think good things about you, that's a good thing, right?
That's right.
That's a good thing. All right. And our phone number, again, is right on our website at egtax.com, 632-7886. Our phone number here is 803-0930, star 930 cell phone. Okay, Social Security. People don't understand when it's taxable. So explain it.
Well, if you're single, it starts off when your MAGI, your modified adjusted gross income, is over $25,000. And when you're married filing joint, it's when your MAGI is $32,000. And everybody right now is going, I thought a Magi is one of the kings that went to see Jesus when he was born. But for the IRS purposes, it's your modified adjusted gross income. So it takes your regular AGI, backs away your Social Security, taxable Social Security, and then adds in half of your total Social Security. And those who aren't confused should be. So and that's where that $25,000 comes into. So say you have a pension of $20,000, you're single, and your Social Security is $12,000. So your MAGI would be $26,000. You got your $20,000 plus half of your Social Security, which would be $6,000, to bring you to $6,000. So you're at $26,000. So then you subtract that from the 25, gives you $1,000, divide it by 2, and you're going to pay $500 of your Social Security is going to count as income on your tax.
And to that $500, that is then multiplied by your tax bracket.
Yep.
So if you're in the 10% per tax bracket, because that's what this person would be, they would pay $50 in taxes.
Yep.
So they did all that computation, and that's what it came down to. So the bottom line is, if your income is not more than $32,000 when you add half of your Social Security to the figure, or $25,000 if you're single, and you add half your then none of your Social Security is going to be taxed, right?
Right.
That's right.
But the important thing is to make sure that you keep yourself under those figures. So you want to be careful when you're taking distributions out. And again, sometimes even though you're paying some taxes on it, it's worth it if you were able to take a lot of money out of your pension plan.
Right. And a lot of people are afraid to start taking their Social Security because they are afraid to pay the tax on the money. But you're going to pay the tax on the money. If your income's not changing, your other income's not changing, your Social Security is going to be taxable no matter what. So you're not really deferring any tax.
That's right. And so that's the important thing. And again, when can you start taking Social Security?
62.
Right. And the thing is, we've done this thing. What you have to do is you have to say to yourself, even though at 70 I'll get a
8%
lot more money,
a month, or 8% a year.
So 8% times 8 years is 64% increase.
Yep.
You've lost all that money over an 8-year period.
Yep, and
so what you have to say to yourself is, even though at 62 I'm taking it, getting a reduced amount, it actually takes me till I'm about 78 or 80 to break even.
And Tim Eliason did a nice spreadsheet on our website, and you can plug in all the figures and you can figure out how many years it would be until you break even for Social Security.
Right. So that if you're leaving on the table, let's say $24,000 a year over an 8-year period, that means you're leaving on the table $192,000.
Yep.
So,
and so
it is true, at age 70, you're going to be getting an extra 64%. But remember, if you're getting 64% extra, it takes a lot of years to make up what you didn't take, the $192,000.
When you pass away, the spouse would get it from Social Security Administration. They would mail you a check, right?
No, ma'am. No, I mean, and that's the other thing. They don't come up to your spouse at the funeral parlor and say, "You left $192,000 on the table. We want to give it to you." It's if you don't take it, it's gone. So, anyway, I'm Esther Gilius, the tax lady, with Tiffany Fabian, Christopher Fabian. We're at EG Tax, 632-7886. Our website is egtax.com. Until next week, and God help everybody down in Florida. I'm Esther Gilius. I hope to see you. Bye-bye.